Did you know that while the market is panicking over this Warner Brothers deal, Netflix actually wins no matter who buys them? Netflix stock is currently sitting at a 30% discount, and it just triggered a secret bat signal. It looks scary right now, but the last time this bat signal flashed, Netflix stock doubled in the following years. In this video, I'll be explaining what that bat signal is and exactly what I'm doing given this 30% decline. Now, you might be wondering, why does my opinion matter? Well, I've held Netflix stock for 7 years and it currently sits in my top 10 holdings. I actually have a video on my channel breaking down exactly what my top 10 stocks are, so feel free to check it out. I think the fact that A, I'm a current Netflix shareholder, and B, I have been for 7 years, counts for something. In the stock market, talk is cheap. How long have you had skin in the game? In other words, do you own the stock? If so, have you held it for more than 5 years? Do you use the company's product religiously? If the answer to all three questions is a resounding yes, then you have my full undivided attention, and I consider you a much more credible source than some keyboard warrior who's just yapping from the sidelines. 3 years ago, Netflix stock dropped by 77%. Yeah, you heard that right, 77%. And despite that drop, I continue to hold. Was I nervous? Hell yes. But I stayed the course. That shows my conviction. And that conviction stems from my thorough due diligence by way of multiple comprehensive deep dives and research sessions through the years. That's why my opinion matters. Why do I own so much Netflix stock? Let's start with the resilient track record. In 2011, co-founder Reed Hastings decided to split the company in two: Netflix for streaming and Qwikster for DVDs. It was an absolute disaster. Customers felt blindsided. They were enraged by the 60% price hike and the inconvenience of managing two separate services. The stock didn't just dip, it collapsed, falling over 75% from its highs. They lost 800,000 subscribers in a single quarter, a number that made Wall Street shit their pants, and for good reason. But this is where the resilience kicked in. Management didn't just apologize and reverse the decision. They realized their survival depended on controlling their own destiny. That near-death experience is exactly what pushed them to bet the farm on the TV series House of Cards in 2013, launching the original content empire we see today, including global hits like Squid Game, Stranger Things, Bridgerton, and K-pop Demon Hunters, which is their most watched title ever, clocking in at about 500 million views and counting. They took a catastrophe and used it as fuel to reinvent their entire business model. Fast forward to 2022, and that narrative shifted from Netflix is arrogant to Netflix is obsolete. The stock plummeted 70% in 6 months after they reported their first subscriber loss in over a decade. The market consensus was brutal. They said the COVID pull forward was over. Growth had hit a ceiling, and legacy competitors like Disney Plus and HBO Max were finally coming to eat Netflix's lunch by reclaiming their licensed content like Friends and The Office. Investors capitulated, convinced that Netflix had no moat without intellectual property of its own. It was peak pessimism, with major analysts downgrading the stock and predicting the company would be crushed by the content wars. This led to the most hated pivot in the company's history, the crackdown on password sharing and the launch of an ad tier. The skepticism during this period was off the charts. In November 2022, Netflix announced they would be introducing an ad-supported tier for the first time. Critics argued that introducing ads would cheapen the premium brand and that Netflix was desperate. Skeptics said it would cannibalize their high-paying users. Instead, the ad tier became a profit engine, attracting a new demographic of price-sensitive users and opening up a massive high-margin revenue stream. Then, in May 2023, Netflix enacted a password crackdown to convert the estimated 100 million people sharing passwords into paying customers. The internet swore that if Netflix blocked account sharing, there would be a mass exodus of cancellations. Cancel Netflix trended on Twitter. Instead, the opposite happened. Millions of friends and family members of existing customers converted into paying customers, driving one of the biggest subscriber spikes in company history. Despite the Qwikster disaster, the 2022 stock crash, and constant doubts about their survival, Netflix stock has appreciated over 3,700% since 2010. That is the definition of resilience. So what's Netflix's superpower? In an age where the biggest tech companies have their hands in all sorts of pies, Netflix stands out. After nearly 30 years as a company, Netflix is still focused on being the best global entertainment distribution service in the world. This hyper-focus is its superpower. You see, Netflix is a pure play. They put all their eggs in one basket, being the best global entertainment distribution service. Let's take a look at their competitors. Amazon is focused on shipping tens of millions of packages daily, AWS cloud services, Whole Foods, groceries, distribution warehouses. Oh, and by the way, they also have a streaming service. Apple is focused on manufacturing iPhones, iPads, MacBook Pros and Airs, AirPods, Vision Pro, the App Store, Apple Pay. Oh, and they also have a streaming service. Disney is juggling 12 gigantic theme parks in California, Florida, Japan, France, China, and Hong Kong, managing dying cable channels. Oh, and they also have not one, but two streaming services. But to be fair, they're doing a pretty decent job. For these competitors, streaming is a side hustle. For Netflix, it's life or death. The entire company wakes up every morning thinking about one thing, not manufacturing phones or groceries or theme parks, just being the best global entertainment distribution service. That laser focus forces them to make better capital decisions than their distracted competitors. Now, let's take a look at the Warner Brothers acquisition, because this is where the bear case falls apart, in my opinion. People are saying, what if Paramount wins the bid? Or why is Netflix taking on so much debt? To understand why I'm not worried, we have to look at free cash flow. If you don't know what that is, imagine a lemonade stand. Revenue is the money you collect from selling the lemonade. But then you have to pay for the lemons, the sugar, the cups, and the stand itself. Free cash flow is the actual cold, hard cash you get to put in your piggy bank at the end of the day after paying all those overhead expenses. It's the only number that really matters for survival. Now, let's compare the piggy banks. In 2023, Netflix put $6.9 billion in their piggy bank. In 2024, they did another $6.9 billion. And in 2025, they're projected to hit roughly $9 billion. They're a cash printing machine. Let's compare that with Paramount. Over the last trailing 12 months, Paramount generated only about $178 million in free cash flow. This is the difference between a strong buyer and a desperate buyer. Netflix is buying Warner Brothers to dominate. Paramount is trying to buy Warner Brothers for survival because their lemonade stand is barely breaking even. I prefer to own the company that buys assets with cash flow, not the one that buys assets out of desperation. And while you might reason that Paramount should be the buyer because they're struggling and they need Warner Brothers, think about it this way. Paramount buying Warner Brothers is like two drowning swimmers trying to save each other. Paramount is barely keeping its head above water. Warner Brothers is a strong swimmer, but they're wearing a 35-pound weight vest. That's their massive debt load. If Paramount tries to save them, they have to strap on another 50 pounds of weights in debt just to reach them. The result? They don't float. They just sink faster to the bottom of the ocean together. It's a suicide pact. Netflix is different. Netflix is the luxury yacht cruising by. They aren't drowning. They're powering through the waves with $9 billion in free cash flow. They can easily reach down, pull the passenger, the Warner Brothers library, on board and keep sailing. The yacht doesn't slow down because of one extra passenger. It just adds a VIP guest to the manifest. And don't forget that Paramount already tried for 3 months to buy out Warner Brothers. They made 6 offers over a 12-week period. And after all that, Warner Brothers board favored a deal with Netflix. But what if the deal fails? What if the government stops it? This is where the SEC filings reveal something fascinating. According to the filings, if A, Netflix walks away, or B, regulators block the deal, Netflix has agreed to pay Warner Brothers a massive $5.8 billion breakup fee. That's a huge number. And I know what you're thinking. How's that good for Netflix, Tony? Well, at face value, that clause looks to be a bad thing for Netflix and its shareholders. However, to me, such a massive fee actually signals extreme confidence. You don't put $5.8 billion on the line unless you've already done the homework, laid the groundwork, and are 1,000% sure you can get this deal done. Now, on the flip side, if Warner Brothers backs out because they get cold feet or accept Paramount or another bidder's offer, Warner Brothers has to pay Netflix around $2.8 billion. So, worst case scenario, the deal falls apart and Netflix walks away with a check for nearly $3 billion. That's a pretty nice consolation prize for Netflix shareholders. The bottom line is this: as long as Warner Brothers gets bought out, Netflix either A, owns Warner Brothers, all its assets and studio lots, or B, gets paid almost $3 billion. If you ask me, that's a win-win situation. So if the financials are strong and the legal confidence is high, why is the stock down? The debt. Investors see the billions of borrowing and they get nervous. But I don't see it as a risk. I see it as chapter 2 for Netflix. To understand why the debt doesn't scare me, here's a little sport analogy. I want you to think of Netflix like the greatest, most winning NBA coach of all time, Phil Jackson, who has 11 NBA championship rings, 6 with the Chicago Bulls in the 90s and 5 with the LA Lakers in the early 2000s. Chapter 1 was the Chicago Bulls era. In Chicago, Phil had Michael Jordan, which is like Netflix having a one-of-one world-class streaming technology. Jordan was amazing, but he couldn't win a championship alone. So Phil had to build a new system called the Triangle Offense, which is like Netflix building original content with key players like Scottie Pippen and Dennis Rodman. It was hard work. They had to struggle and learn how to win with this new system. But once it finally clicked, they dominated the decade. 6 championships for the Bulls, and in Netflix's case, from drowning in debt for many years to a profit powerhouse that keeps growing. Chapter 2 is the Lakers era. After winning 6 championships with the Bulls, Phil went to the Lakers. This time, he didn't have to build a star from scratch. He walked into a gym that already had Shaq and Kobe. He didn't need to teach Shaq how to play. He just took his proven system, the Triangle Offense, and plugged the biggest stars in the world into it. That's exactly what Netflix is doing right now. They aren't borrowing money to gamble on finding the next Michael Jordan. No, they're taking their proven championship system, that engine of 300 million subscribers in 190 countries, and they're applying it to the Shaq and Kobe of content. Harry Potter, Game of Thrones, Batman, and DC Comics. Phil Jackson didn't win 5 more rings in LA by reinventing the wheel. He won by applying his proven system to the biggest assets in the world. Netflix is doing exactly that. They're taking the biggest library in history and plugging it into the biggest distribution engine in history. And that's why I'm not worried about the debt. They've leveraged up before to build a dynasty, and they paid it off with growth. Now, they're doing it again, not to compete, but to conquer. And finally, that brings me back to the secret bat signal I mentioned at the start of this video. If you pull up a chart of Netflix's finances from 2016 to 2019, you'll see something that looks terrifying to the amateur investor. Free cash flow didn't just dip. It dove off a cliff. Wall Street called this the Valley of Death. They were burning billions to build House of Cards, Stranger Things, and The Crown. The chart looked like a company bleeding out. Because they had spent that money building an engine, the moment they throttled back on spending, the cash flow didn't just recover. It shot up like a rocket. It went from negative $3 billion to positive $7 billion in just 4 years. That's a $10 billion swing. The acquisition costs for Warner Brothers are going to send that chart back down into the red temporarily. That's the bottom loop of the J. But remember, last time they were burning cash to gamble on making new shows. This time they're spending cash to buy global household names like Batman, The Lord of the Rings, and Harry Potter. The bounce back, the upward stroke of the J, is going to be faster, steeper, and higher than anything we saw in 2020. But just like before, it'll take some time. likely several years, for that J to swing back upwards. And Wall Street doesn't like that. Longer term bets introduce debt and uncertainty, and Wall Street hates that. They want quick results, short term, hence the significant drop in stock price. I'm buying the dip because I'm not looking at the valley of death today. I'm looking at the $15 billion profit rocket waiting on the other side. So here's the bottom line. We've seen this script before. Every time Netflix has faced a moment of crisis, whether it was Qwikster in 2011 or the stock crash of 2022, the crowd panicked, Wall Street sold off, management executes, the stock doubles, and the patient investors got rich. I get that the market sees a debt problem. What I see is the world's most dominant media company buying the world's best assets at a discount. The streaming wars are officially over. Netflix won. They're just collecting the spoils of war. And for these aforementioned reasons, I'm betting on Chapter 2. I'm adding to my Netflix position and buying aggressively on this 30% decline. But I want to know what you think. Are we looking at a debt trap or the deal of a decade? Let me know in the comments below. Hit that like button if you appreciate the research, and I'll see you in the next video.